In previous videos, I looked at a number of things, including put and call options, some updates to how they're quoted and traded, types, and in particular, annualized returns to put and call options with a particular focus on call options, wherein, if you had a quarterly option, you could sell them 4 times a year. And let's start in a place I bet you wouldn't expect, and that is ETFs, exchange-traded funds. These are much like mutual funds in that they are portfolios of one kind or another, and the SEC has been leaning toward let's keep these index as opposed to, say, actively managed funds where the stock picking, which historically has not done too well anyhow. And because they trade like stocks, you can have options on them like stocks. And many of them, the ETFs at least, you can trade for free, much like sometimes, in some cases, mutual funds. But in all cases, you will pay a commission on the option itself. Time for a quick review. Put and call options differ from futures contracts in that a futures contracts you're obligated regardless of whether you're ahead or behind. With an option, the owner owns the plus side, the seller owns or is obligated to the negative side. I have a couple of examples here. Do be reminded that an option is for 100 shares, so if you had 200 shares of a stock or an ETF, you could have 2 contracts. Let's do an example, the exercise strike price, if you will. Let's make it at 40, and the stock maybe goes to 42. Well, the call's worth 2 points, but the put's not -2 theoretically, but 0. What if the stock drops 5 points to say 37? Strike is still 40. Well, the call drops to 0, theoretically -3, and the put rises to 3. Likewise, when these were created in 1973 with the Chicago Board of Options Exchange, there are now others, they were at first monthly options, ceasing to trade on the 3rd Friday of the month, plus leaps, those are the January versions going out 1, 2, sometimes 3 years. The strike exercise prices are in $5 units, although 2.5 if it's below 25, and often the ETFs have strike prices in $1 units. They trade in pennies or nickels above $3, but often the ETFs will trade in pennies regardless. There are now also others such as monthly, weekly, quarterly options. One can get information about option choices by looking up what are called option chains. You get various expirations and various strike prices. I happen to have just selected 4 of literally over a dozen expiration choices, and I've just truncated this to show some of the examples in terms of near the money, that is slightly above or slightly below their exercise price of both puts and calls. And the nicety here is this broker happens to display the in the money calls and puts at a slightly darker blue color here, which is also note that means that when one is in the money for a put, the other is out of the money for the call. Here's an example of an order ready to be placed. See the description of the option up there. It describes the stock, the security, the date for the expiration, strike price, C or P for put or call. Old days they used to use the first 12 letters of the alphabet for the calls, and the next 12 letters of the alphabets for the 12 months for puts in special cases such as stock splits. You can use limit or stop orders or market order if you like. We're going to talk about that. And notice we have a little bit of a bid-ask spread. And if you look, the bid-ask spread is a little bit more important in the case of options than, say, underlying security prices, in that the decimalization ordered by the SEC, where we moved from half, quarter, eighth, 16th pricing to pennies for the underlying security, if they're major ones, is frankly at a difference of 1, 2, or 3 pennies, but in the case of options can be significant. In this example, which I purposely made to show that it's trading in nickels above $3 and pennies below $3, and look at that difference between, well, wait a minute, what if I were to go in there and make a market order to buy? I'd buy from the seller, I'd pay $3.35. And if I had a market order to sell, I'd receive $2.97. That's quite a difference. Remember, it's times 100. And a suggestion is to kind of make the analogy that the spread is like dipping your toes into the water of a moving river. And if I wanted to sell, I could keep dropping it. If I wanted to buy, I could keep making the price rise. And it turns out there's studies that says that's worth the effort, although sometimes you do miss a major market move. Going back to the fundamentals of options here now in graph form, you can trade any of these in any combination. I don't recommend that. You can buy insurance. It's called a hedge on a long position. What do we do to cancel that red loss? Only one thing, buy a put. What do we do to cancel the red loss on a short position? Only one thing, buy a call. I don't recommend that for reasons we'll see. You can trade these in any old combination. You speculate on stock rising, buy a call, sell a put. Speculate on the stock falling, buy a put, sell a call. You can put them together in all kinds of oddball combinations. There's butterflies, spreads, straddles. You can buy them both, sell them both. I don't recommend any of those. I recommend instead using them in lieu of limit orders. And to do that effectively, we really got to see what's really going on underneath. What we've done so far is only the intrinsic value. Here we have a call. Wow, that looks fabulous. It only goes up. Wait a minute, it's going to cost you something. And we're going to call that the premium. Likewise, the opposite side of buying a call is selling a call. God, that looks horrible. Well, that means you're going to have to be paid a premium, much like an insurance company. And while those previous graphs are correct in a conceptual sense, it's actually added on, and the cost occurs because across time that premium will decrease. Again, thinking of it like insurance. Notice that excess premium is usually the biggest nearest the exercise price, what we call at the money. So we're ready to put this all together, and I'm certainly not the first one to have done this, is that you take those excess premiums and you can annualize them, divide by the amount of time to the expiration. And I'm certainly not the first one to have done this. A guy named Scott Nations wrote about it. Here's a graph that I created from his data. Now take a long look at it and see if you can see a pattern. Here, let me help you. And I didn't mean the fact that the Caterpillars had a November expiration, whereas the IBMs had an October expiration. You know why. Yes, you do. For each one of these three expirations, I've got three different strike prices, each one of them out of the money. The left of each three is very close to the strike price, and the right of the three is farther out of the money. And I've now put some lines in there, and notice that when they're near the money, they tend to decrease across time, but when they're farther out of the money, they increase across time. Now, you could, if you like, go to the Chicago Board of Options Exchange, and they have a little calculator there that will have you compute the Black-Scholes options pricing model. And here I've written out all the math for you, and I did a little abbreviation D1, D2, which is standard in the field. We'll see that later. And notice, among other things, it's a function of the square root of time, security and strike price, volatility measured in standard deviation, interest rate is in there, it's a little bit low right now, and something called E, that 2.7 number, that's for instantaneous present value compounding. And we go to their options calculator, and you can specify whether it's an American option, can be called anytime, European option, only at expiration. There's even Asian options. That's where you get an average price. And you can plug in all those statistics. And I did one here to just check my work. And on the right-hand side, oh gosh, they have something called Greeks. And for anybody who is in a sorority or fraternity, you'll actually see some of them are not Greek. So you can say it's Greek to me. Here's an explanation of those Greeks from Wikipedia. And notice on the right-hand side, I brought your attention to the fact that they use calendar dates to compute the time remaining, and they use K instead of X for the exercise strike price. Let's see, we have delta. That's the change in the price of a call or a put versus the underlying security. Suppose the call had a 0.8. 80% versus 100. Suppose the put was 0.4, 40% versus 100. You could perhaps buy 2 puts and sell 1 call, or vice versa, and the 2 would balance each other out. Gamma is the rate of change in the delta. That's for you math freaks. Let's see, Vega. Yeah, that's right. Vega is not a Greek letter. And in fact, you'll notice on the bottom, it notes that that's a misreading of the Greek letter lowercase nu, which does kind of look like a V. Theta is time. Yeah, in Greek it should be chi for chronos, or maybe transliterated as T for tau. Don't get me started. And we also have rho for interest rates. Here's another place to get computations for option pricing. There happen to be other models out there. There's a binomial model, and yet another one that takes into account dividends. And in fact, that Black-Scholes model, Merton threw in the dividends as well. This one happens to come from Charles Schwab, and that's not all. So as we get ready to start putting this all together, let's be reminded that a call owns the upside of a stock, the put owns the downside of the stock, and you can go the other direction for those of you who like to go the other way, in that you can sell these instead. And I'm going to recommend that in lieu of limit orders. That is, if you want to sell a stock, you sell the call. If you want to buy the stock, you sell the put. And in all cases, you receive that excess premium regardless whether it's exercised or not. And that excess premium is a function of whether it's at the money, near the strike price, the volatility of the stock, better yet, the expected volatility. Time to expiration is a square root of time. And, watch out for those puts, especially because those ex-dividends will lower the price once the stock has gone ex-dividend. Interest rates are in there, but not too high at this time. So my insight was to take this a little bit of a different direction by doing a simulation. And there are simulations out there, and there's the Wiener process. By the way, notice this is misspelled in Wikipedia, reminding you of that old admonition, as Abraham Lincoln said, don't trust everything you see on the internet. And a good detailed look at the notes below say that this model is really only good for short-term estimations. And I'll show you why. And unlike the simulation which I have shown here of a realistic stock price scenario, the previous one, actually, if you pushed it out, it did say not to push it out, you could actually wind up with a negative stock price. That makes no sense. Notice here a more realistic simulation, I'll show you how, is the price doesn't ever go below zero. Kind of gets squished at the bottom, and likewise actually rises possibly almost infinitely upward. And a close attention, this is mean zero, the median price does decline, and the distribution starts to become, here we go, a gamma Poisson distribution, skewed more upward. And that's proper. Think about all those prices of the stocks that nearly went through the ceiling. Here are some examples I did from a previous publication and a previous simulation. And no surprise, at the money, these happen to be $100 priced security, and the exercise is 100, and you do get a larger excess premium. Now, the next one, 110, it's 10 points out of the money, has a lower excess premium, and, well, wait a minute. What if I were to draw a line making a tangency? Here, like this. And if you think about it, go ahead, think about it. It won't hurt. If you think about it, the tangency is where you get the greatest annualized returns. And notice, well, they are lower when the stock price is farther out. That makes sense. And it turns out they're also farther out in time. Here's one I did from a previous simulation. Each one of the bars is a 1 unit increase in the strike price out of the money. And subdivided within that is each of the monthly annualized returns. And let's see, they do decline when they're near to the money. That's on the left. And they do rise, albeit lower total annualized return on the right. And in somewhere in the middle, there's kind of a hump. And that's just about as far as I got the last time. And I realized I needed to do more. Why? Well, the main reason is, recall that there are annualized long-term leap options that go out 1, 2, 3 years. And secondly, you really can't tell where the hump is, can you? I mean, it kind of occurs around, 12, 11 points out of the money. Remember, there's 100, so it reads here as 111, 112. And that's where my latest research came in. And here are some recent exemplars. Here happens to be Bank of America, and I'm using the theoretical values. Those are the reds here. When they're above the line positive, that means you are in the money, and below the line, you're out of the money. There's the various strike prices to the right thereafter for each strike price. And notice some of them are missing. You now know why. Underneath, I have a history of the last 20 months of what happened. I happened to buy the next year out, replacing the previous year, moving up the strike price. So I kind of locked that in. Here's General Motors, and let's see, again, near the money, seems to decrease as we go annualizing out in time. Rises farther out in time. There's a little bit of a hump there. In this case, I didn't have to move up the strike price, but I did roll it over and get a higher return by moving out to the next year. Here's Microsoft, and again, being in the money is the red bar is above the line theoretically, and sure enough, the annualized returns decline as you move farther out in time. When you're out of the money, they are, albeit at a total lower annualized rate, but start to increase. Here's a case where I took a hit on the option, but locked in a gain on the underlying stock, and you'll see I shifted strike prices. Here's Verizon Communications, and notice again there's a lot of gaps here, and you now know why, because some of them do not offer all strike prices for all expirations. And again, I moved the expiration up, locking in the gain. And here's an ETF, the Spider Diamonds, the Dow Jones Industrials ETF. And here's an example of do what I say, don't do what I do. For the underlying security itself, you'll see it rose. Sure enough, as it got farther and farther out of the money, the difference between the two, the excess premium did diminish as expected. But I threw in there the fact that I decided to go naked, without the underlying security, trying to short the market. And so far, that's been a loss. But this illustrates a number of things. And remember, these are all presented for illustrative academic purposes only. No liability to be inferred or implied. Okay, here are my results. Simulation. 1% per month. That's about 3.5% per year. Remember, it's a square root of time, square root of 12. And this would mean you would have about 95% of the time, that's about 2 standard deviations, going up or down about 7%, 2 times that 3.5. And notice as you move out in time, it starts to level up. Here's the bit more realistic 2% monthly standard deviation. That would be an annual standard deviation, square root of 12, of about 7%. 95% of the time, that means the stock would be roughly between about a 14% gain or loss. Let's look at the 1 year leap expiration. Where does it hump? Annualized returns around about 5 points out of the money. Notice that's 2.5 times the monthly standard deviation. Now here's the even riskier 3% monthly standard deviation. That's an annual standard deviation of about 10.5. And again, let's look at that 1 year expiration, a leap if you will, and it's somewhere between 7 and 8 strike price out of the money. Again, 2.5 times the monthly standard deviation. Finally, here's 4% monthly standard deviation. That'd be about 14% annual standard deviation. And 95% of the time, you'd have a range somewhere between plus or minus 28%. And slightly off the chart, but we can eyeball it. Where do we get the maximum for the 1 year expiration? It's about a strike price that's 10 points out of the money. Again, 2.5 times the monthly standard deviation. Well, what does this all mean? Formally, that for out-of-the-money call options, where the idea is you're just merely selling the call option in your preparation if you want to sell the underlying stock, that you're getting the dividend from the stock, the possible capital gain to the out-of-the-money strike price, and the annualized return from the option, that the boundary, the milepost, the place from where you go from out of the woods is around 1 year. And anything beyond that starts to level off. To restate that, that's about 0.7 times the annual standard deviation. And indeed, of these extreme scenarios, we seem to be, it's almost always the same. And there the point is, this is not so much to maximize the annualized return as to recognize the boundary of where it becomes optimal. Something to think about with Dr. C Invests. Bye.